Russell 2000 outperformed the broader market at the end of last week as tech stocks continue to be under pressure, of course, led by Nvidia. Could this be the time for a catch-up trade led by broadening out? Joining us to discuss, and here on set, we've got Jason Pride, Chief of Investment Strategy and Research at Glenmede. Thank you so much for joining us here, Jason.
Thanks
really
for having
appreciate
me,
it. I know you just heard our conversation with Paul, and I'm curious, what stood out to you in terms of the concentration we're seeing in tech versus a strong desire to have a broadening out, but are we seeing evidence of that broadening out really starting to happen?
So I think it's probably going to take a little bit of time for us to actually see that broadening out. Quite often when we see innovation cycles, what happens is we go through a period of hype through which valuations get stretched, often to a point that's hard to discern at that point in time. I heard you talking about how hard it is to value a hyper growth issue. That actually is a problem within investment analysis. Everybody's grappling with today with things like Nvidia. But quite often following that hype, there is often a period of disappointment, meaning that we build up high expectations for some issues that eventually get to a point where they just cannot be met. And that period of disappointment shrinks the valuations. And then maybe later in time, if you look back at the internet cycle, we went through this and eventually there was a realization on the other side 10 years later. All that hype actually ended up being true. They ended up being true 10 years later rather than within that exact time frame that everybody was hoping for. So that may play out again this time.
So is it less that you're saying don't be bullish on the stock, it's more that you're saying there might be a buying opportunity to get in when it's cheaper?
Exactly, and I think that's where investment discipline comes in. These sort of environments require investors to, number one, be comfortable with not chasing the trade, and number two, actively rebalancing portfolios. Because what's going to happen if you have a broad market exposure and you have something like Nvidia or other tech stocks lifting ahead within the portfolio, that's actually going to provide you an opportunity to trim back that exposure and buy the things that have underperformed up until then, rebalance the portfolio. Let's not eliminate that exposure, but reduce that exposure and manage the risk. That's what this sort of market environment provides opportunity for.
What does a healthy rebalancing look like then?
The healthy rebalancing can simply be you establish targets for your investment parameters up front. You then look at those targets at a later point in time and look at what is off from those targets. So if Nvidia has run beyond your typical portfolio limits of exposure, bring that back to your portfolio limits of exposure. If equities have run beyond your target equity allocation, bring that back to your target equity allocation. That allows you the opportunity to buy other things within equities, buy other things within broad asset classes like fixed income of all things. I mean, fixed income today is offering 5% plus yields and opportunities for investors that we haven't seen in 15 years, right? So there is an opportunity here for investors to rebalance their portfolio back to a more disciplined portfolio allocation.
It's interesting. I know that your conversations are much more high level than this, but when I talk to my mom about her 401k and she's getting advice about going international, being in bonds, I'm like, well, you're missing out on the Nvidia rally, right? How do you tell people like me, don't think about it like that?
The thing is, I think that's actually a misconception. If you own that, you're not missing out on it. You're just managing the risk associated with it by buying into the small caps, by buying into Japan, international, other areas of the market. You're actually taking advantage of all the opportunities that exist around the spectrum and not just one opportunity. And you're still not missing out on that one. You just may be minimizing your risk associated with it.
It's about hedging the greed, it sounds like.
Exactly.
But I don't want to hedge the greed when I'm seeing, what is Nvidia up year to date? 166%, right?
And I think that's the trap that investors quite often fall into is you look in the rearview mirror over a very short period of time and say, hey, I'd really like that. Well, you are not guaranteed that what you've recently seen is going to recur over and over again in the future. In fact, likelihood is it doesn't. And by diversifying your exposure, by maintaining a discipline in investing, you actually maximize your chances of getting that in other areas.
Right, past performance, not indicative of future results there. I do want to get your take on what we're seeing in the broader economy while we have you here. Obviously, PCE data coming up on Friday. What would you be expecting to see from that data to indicate a timeline for the Fed?
Yeah, so we need to see continued moderation in inflation. It could be stepwise, it could be little pieces over time. The Fed wants to see it, we think the Fed needs to see about 3 months in a row of inflation just kind of gradually seeping down from these recent higher rates. The beginning of this year was hotter than they wanted. They had to back off from the previous expectations for faster rate cuts. They are now looking at 1 to 2 We actually think they probably will end up doing 2 this year. There's a good chance they'll end up doing 2 because the inflation data is probably going to moderate as we go through the rest of this year.
Why?
And 3 months in a row, just because of the way the seasonality works, because of the way the interest rates work and the impact in the housing components, the way we're already seeing it work in the wage numbers and the services inflation. Last month's services report within CPI was actually shockingly low. It was the first one we've seen out of the last 4 that actually surprised to the downside. So if we see a couple months like that, the Fed can look back and they have an excuse on the table to bring rates down from what they already consider to be overly high levels and start getting down to where they ultimately want them to be longer term.
The housing data was a little rough as well recently in terms of housing starts, housing supply. To what extent do you think the Fed's relationship to housing is something that potentially needs to change moving forward, given that higher for longer is keeping people stuck in their houses longer, and that is potentially in some ways fueling inflation?
I don't know that I really think of it as the Fed needing to change the relationship with housing. I think this is a complication of monetary policy that they are always dealing with, and they're dealing with it more today than ever before because people are locked in at lower rates. This is we think, a typical late cycle environment. We actually thought we were going to have more difficulty earlier. We'd even thought that a recession was probable last year. That is now extended into a late cycle. A late cycle is typified by GDP running ahead of expectations, or running ahead of potential. That's where we are now. Inflation running hot. That's where we were. Interest rates coming up and market valuations being high. It doesn't mean that we have an immediate recession, but they're dealing with handling a late cycle, what is probably going to be a late cycle slowdown here, and trying to push that late cycle, that expansion out as long as they can. That's a difficult thing for the Fed to do. So I don't really think of it as something they need to change their thought process about. I think this is just a difficult thing for the Fed to manage.
It's just how it is, given the
how it
tools
is.
that they have at hand. Given that, and kind of zooming out here as we wrap up, what do you think is the biggest potential risk for the economy in the U.S. as the Fed does start to fight inflation? Is it something that is, related to monetary, fiscal policy domestically, or is it a geopolitical international challenge?
One of our biggest concerns has been around the monetary policy, how tight it keeps the overall markets, how much pressure that puts on the average consumer. So far, we haven't seen that play through because debt markets have actually stayed reasonably good. Equity markets have been very good for corporations. You haven't seen that typical flow through in the capital markets that actually impacts the rest of the economy. The other thing that we haven't seen is we haven't seen the lower end of the consumer suffer quite as much as it typically occurs in a recessionary environment. This time around, they have had a lift of wealth that occurred from the past stimulus that has actually saved them this cycle so far. We are keeping very close eyes on the consumer. We're seeing a rise in some delinquency rates, but really it's looking like just back to normal. We're going to be keeping our eyes on that lower end consumer because if that pocket gets larger, that pocket that's having difficulty gets larger, that could be one of the tipping points.
So real quick, things like the pricing war and value meals at some of these lower end fast food chains, that's not a concern to you?
Actually, I think that could be a saving grace here. That could be one of the things actually brings the inflation down, allows the Fed to see the inflation data coming lower, and allows the Fed to start backing off on their interest rates. We've waded through a cycle where the Fed raised rates, fiscal policy provided an offset to that. Now we need them to cross each other. We need fiscal policy to back off at the time that monetary policies, downside to the economy backs off as well. If those cross at the same time, we could actually extend this late cycle quite a bit further.
Really appreciate it, Jason. Thank you so much for coming in, and thanks for the great commentary.
Thanks, Madison.
Appreciate it.